Good afternoon. My name is Perry Tan, and gives me great pleasure on behalf of the Singapore College of Insurance, right, to warmly welcome all of you to this afternoon's webinar on carbon insurance and climate risk on behalf of SCI and Aon. All right, so let's have the event slides, please. Thank you. All right, here are the speakers' profile. So let me just briefly give a brief introduction on our two speakers for today. Today, we are most honored to have two esteemed speakers from Aon. The first speaker is Dr. Muhammad Rahis. He's a Director of Analytics and Catastrophe at Aon. His profile is shown here. Dr. Muhammad has a Doctor of Philosophy from Oxford University and post-qualification experience from Cape Town and Dubai. His research is on the utility of climate model outputs in decision-making in the light of climate change, with focus on food and water security. He has spent several years in the insurance industry in the areas of catastrophic flood model development, and has had applications to disaster risk management and financing. He has been with Aon Reinsurance Solutions since 2022, where he currently serves as a director of catastrophic management analytics, overlooking the Philippines, Vietnam, Thailand, and Pakistan. Next, please. Joining him today is Mr. Tham Yap Phuong. He is the climate risk analyst APAC of Aon. Yap Phuong is a climate risk analyst at Aon, bringing a decade of experience in weather and climate services with a background in physical and meteorological sciences. He has contributed to various regional initiatives in the past related to multi-hazard watch services, working with organizations ranging from commercial enterprises to international development agencies. He has extensive experience in applying climate projection modeling to help organizations conduct future climate scenario analysis. And he has also undertaken various projects, including risk assessments to enhance climate across various infrastructure projects across the region. You can see the brief synopsis today. Basically, it offers a comprehensive introduction to evolving intersection of climate change, catastrophic events, and the insurance industry. Next slide, please. Okay, and here are some of the other courses that you may be interested. Today's webinar is, of course, on climate change, and some of our courses are in relation to climate change and sustainability. For example, you have renewable energy projects, a course on climate and environmental risk management in ASEAN. Next one, risk management insurance for renewable energy projects, environmental risk and its impact on the insurance industry, various dates throughout the year. If you need further information on these courses, you can just drop us a line and we will give you the details. Okay, all right. So we come to our main highlight for this afternoon. All right, I shall now hand it over to Mr. Yap Phuong Tham to commence his presentation on this webinar.
Thank you, Perry. Let me just quickly share my screen. Let me know if you can see the screen already.
Yes, we can see.
Okay, cool. Right. Thank you again, Perry. And first and foremost, I'd like to extend a warm welcome to all of you joining this webinar. My name is Yap Phuong, and I'm joined by my colleague, Dr. Muhammad Rahiz today. And we are delighted to be here with you to explore one of the most pressing topics in today's world, climate change and the opportunities that it presents to the insurance industry. Now, before we begin, I'd like to thank the Singapore College of Insurance for hosting this event. And it has been a great pleasure working with the SCI, and we deeply appreciate SCI's commitment to professional training and development for these professionals in the insurance industry in Singapore. So without further ado, let's dive into today's topic. There'll be two parts of the session today. In the first part, I will cover the introduction to climate risk. I'll begin with an introduction to who we are and what we do, followed by some of the basic concepts and terminologies of climate change and climate projections. And then we'll also discuss the most recent losses from catastrophe and climate risk. And that will be followed by some of the discussion on the regulatory landscape relating to climate change. In the second half of the session, Muhammad will walk us through some of the opportunities of the insurance and reinsurance industry, giving us an overview of the climate change and catastrophe modeling, some of the opportunities for the insurance industries, as well as some other considerations that needs to be taken into account when we help our clients navigating the challenges presented by climate change. This will be concluded by a few case studies examples to give you some real life examples of how we actually assist and help our clients navigating these challenges. Last but not least, we also have a Q&A session, and we look forward to discussions with you during the Q&A session later. So as introduced earlier, we are from Aon. Now, I understand that this may not be a brand that everyone is familiar with in day-to-day life. So I just want to spend a couple of minutes introducing ourselves just so that you know who is speaking to you today. Now, Aon is the leading professional services firm in risk management. We are a broker in insurance and reinsurance. So by revenue, we are the largest reinsurance broker and the second largest reinsurance broker in the world. And some of you might also recognize us through some of our sponsorships in sports. For example, we are a sponsor for the Ferrari F1 team, sponsor for the Ryder Cup, as well as a shirt sponsor for Manchester United in the past until like around year 2014 during its glory days. In terms of what we do, generally we categorize our solution lines into two groups. The first one is risk capital, and the second one is human capital. Under the commercial risk solutions in the risk capital group, we help commercial corporates and organizations to identify, measure, and manage their risk exposures. In the reinsurance solutions, we help insurers to navigate their risk and design appropriate risk transfer solutions for them. Under the solutions lines in the human capital group, we help companies and organizations to improve employee health and well-being, attract and retain talent, and optimize investment performance, enhance wealth management strategies for the fund managers and asset owners as well. As for our presence, we have global footprint of around 60,000 colleagues around the world. And within Aon, there's also a group called Aon's Climate Risk Advisory, which Muhammad and I are members of. So this is a global team of more than 80 plus core members, consisting of climate experts, actuaries, enterprise risk management specialists, engineers, as well as strategy consultants. While this is a global team, it's also worth noting that a lot of the analytics capabilities are also developed in Singapore, where we have a climate innovation hub based in Singapore, which has also received a major 10-year investment from the Singapore government. And you will see in some of the case studies later, some of the tools and analytics capabilities that the Innovation Hub has developed. Now, before I conclude or wrap up this section, I just want to emphasize that the things or the climate services that we do or we provide at Aon, we do try our best to incorporate the latest science in it. And we have close collaborations and partners with academic institutions around the world. In the APAC region, we have close collaboration with the universities in Japan, Hong Kong, Singapore, as well as Australia. And in fact, some of our colleagues are actually affiliated to some of these academic institutions. Take, for example, my manager, he's an adjunct fellow at the Climate Change Research Center at the University of New South Wales. So now let's just review some of the foundational concepts of climate change and climate projections. Now, since I do not know the background and experience of each and every one of you joining today, and given that this session is meant to be an introductory session to the topic, I'll begin by introducing some of the very basic concepts and terminologies before we dive deeper into this topic today. Now, what is climate change and actually what causes it? Now, based on the definition in the IPCC glossary, climate change is the change in the state of the climate. And what's meant by that is that it's the change in the long-term mean or variability of climate conditions, such as temperature, humidity, or rains, for example. Now, you may wonder what or how long a period is considered long-term. So typically, we do take a 30-year period as a climatology, and we will consider any change in the average or the variability within this 30-year window as the change of the climate conditions when we talk about climate change. Generally speaking, there are two types of drivers of the climate change. Natural variability is one of them, and it can be driven by internal factors such as the redistribution of the energy through atmospheric circulation, which is the cause to our one of the causes of our day-to-day weather patterns as well. As for the external natural factors, that include, for example, the changes in the Earth's orbit, changes in solar activities, or any major volcanic eruptions that may reduce the global mean temperature due to the ashes blocking the incoming solar radiation. So these are just some examples of the natural variability factors. And as you all know, human influence is another driver of the change in climate. The increase in the greenhouse gas concentration in the atmosphere due to the the use of fossil fuels, the change in the land use is again another factors contributing to the change. So you may also wonder, like, which of these two types of drivers is actually contributing more to the change that we experience today. And in order to answer these questions, scientists have actually conducted simulations using climate models to help us to understand the contributions of the change that we experience today. Aside from using simulations from climate models, they have also synthesized the evidence from other sources such as long-term records, observation data, and analysis of physical evidence such as like tree rings or ice cores. The results are that multiple lines of evidence have suggested that human influence is the dominant factor driving the recent change that we have experienced. As you can see from this chart, the green line here denotes the results of the simulation if we only consider the natural causes or natural variability in the climate change. And we can see that if the natural causes are the only factors, the range of the change in the temperature that we can expect today is not going to be as significant as what we experience today, which is denoted by the black line here, which is the actual observations or the actual records of the temperatures, the global mean temperatures recorded, which is actually closer to the red line here, which is the results of the simulations based on the increase in the greenhouse gas concentration in the atmosphere due to human activities. So now I've mentioned the use of model simulations or climate models in understanding the changes in climate in the past. And climate models are also used to understand the projected climate conditions in the future. But what are these simulations and what are climate models? So in short, a climate model is a complex computer code that creates a digital analog to the Earth, and they use mathematical equations that represent the physics behind it and characterize how energy and matter interact among the different components of Earth, like atmosphere, ocean, land, and ice surface. Now, these are just some examples of a very simplified version of the maths and the physics behind it in like Navier-Stokes equations. But don't worry about it. I mean, it's not a course on fluid dynamics. But I just want to share these and emphasize that running a climate model is a very expensive exercise. And it often requires some of the supercomputing facilities as well. So in order to coordinate and make the best use of the climate modeling sciences, the Coupled Model Intercomparison Project, or CMIP, was established. It began in 1995 under the World Climate Research Program, and it is a project that provides the climate scientists a database of coupled model simulations following a standard experimental protocol. There are many phases of this project, and the latest one that has concluded is the sixth phase of CMIP. We call it CMIP 6, which consists of the outputs from 134 models from 53 modeling centers. Now, the significance of this international climate modeling project is that it makes the multi-model output publicly available for analysis by the widest climate science community. And one of the most significant use case of it is that the output of these climate projection models also forms the basis of the Intergovernmental Panel of Climate Change, IPCC's assessment. So for those that are not familiar with what IPCC is, it is a United Nations body created in 1988 by the World Meteorological Organization and the United Nations Environment Programme. And the main mandate is to provide scientific information to help governments of all levels develop the relevant climate policies, and also serves as an input to international climate change negotiations. So every about 5 to 7 years, based on the cycles and the outputs of the CMIP projects, the IPCC will also publish the assessment reports, which provides a comprehensive summary of what's known as the drivers of the climate, and also the impacts and the future risks, as well as how we can adapt and mitigate these risks. So we have learned that climate models serve as a scientific basis for the assessment of past and future climate. But one thing that we need to bear in mind is that the future is uncertain. And in fact, the degree to which climate would change would depend on the greenhouse gas emissions, which are also closely tied to the patterns of the society and economic growth, due to the factors such as international cooperation to reduce the emissions, political determinations, and also technological progress. So instead of relying just a single set of forecasts or a single set of future projections of the climate, the best practice is to consider a range of the future climate scenarios. So a scenario is simply a plausible description of how the future may develop, based on some of the assumptions about the key driving forces that mentioned earlier around emissions trajectories, technological changes, prices of carbon, the GDP growth or population growth, for example. And what you're seeing on the right here are some of the representatives concentration pathways, which are the scenarios used in the previous version of the CIMMYT project. And each of them represents trajectories of the emissions from present day to the end of the century. And based on these assumptions on the concentration of greenhouse gases, the climate models then produce a different set of projections for each of these scenarios. And hence you can see that the levels of warming that we can expect by the end of the century is different for different scenarios. For example, the RCP 8.5 is sort of like worst case scenario where we can expect a global mean temperature to increase at around 4.3 degrees Celsius. Now, speaking of scenario, you may also come across the terminologies like SSPs, which stands for Shared Socio-Economic Pathways. Now, this is the latest set of scenario used in the CIMMYT 6 project and in the latest IPCC 6 assessment reports. There are a total of 5 SSPs characterized by the socio-economic challenges they imply for mitigating and adapting to climate change. For example, SSP1, sustainability. In this scenario, there are few challenges to adaptations and mitigations, and the focus is on like clean energy, like low assumption and low population growth. So those are the assumptions that are the underlying assumptions in this scenario, as compared to, for example, SSP3. In contrast, that's the scenario where we expect the world to focus on security and local issues and regional issues rather than the global climate issues. And that's where we can expect the world to rely heavily on fossil fuel use as well. So there's all these different assumptions that are embedded within each of these scenarios. It's also worth noting that within an SSP scenario, there can also be multiple emission scenarios. For example, within SSP1 scenario, there is this SSP1 1.9 scenario, as well as SSP1 2.6 scenario. And each of them have a different assumptions around the emissions trajectory. And then the climate projections based on these scenarios would also have a different levels of warming by the end of the century. So now the question is, why does it matter to us? I mean, why does climate change matter to us? Why do we need to learn so much about it? We can understand it based on the losses that we have experienced or contributed by the catastrophe and climate risk that we have experienced today. So these are just some figures that I've extracted from our annual Climate and Catastrophe Insight report that we publish every year. So just last year, the total economic loss that we have recorded is 260 billion. And in terms of the number of catastrophic events that have exceeded the billion-dollar economic loss threshold, there are 49 of them. And the Palisades and Eaton fires in the US were the costliest individual catastrophic events of the year. And this is followed by the Myanmar earthquake and the seasonal floods in China. Both of them are in the APEC. Now, some of the good news about last year's figure is that the 260 billion economic loss is actually lower than the long-term average. The 21st century average is about 23% below the 21st century average, and it's the lowest since 2015. But having said that, even though it's the total economic loss is lower than the average, if you look at the insured loss, which is at 127 billion last year, it's actually 27% above the 21st century. And if you look at the number of events that exceeded the threshold of billion-dollar insured loss last year, we have 30, which is also significantly higher than the average of 17. And if you look at the breakdown by the types of perils that's contributing to this insured loss, we can see that most of last year's insured loss are actually contributed by what we call the secondary perils in the insurance and reinsurance industry. And that includes perils like severe convective storms, flooding, drought, wildfire, and winter weather, as opposed to the primary perils like tropical cyclones, earthquake, and European windstorm. So these are some of the summary of the economic losses and insured losses that the world has experienced last year. Now, in terms of the protection gap meaning the difference between the economic loss and the insured loss, the global protection gap actually narrowed to just 51% last year, meaning 51% of the economic loss are not insured. While this is the lowest on record, but that is because most of the insured loss or the events is insured. I mean, based on the contribution from the insured losses experienced in the US, which has high insurance penetration. But if you look at the regional breakdown, we can see that in APAC, we actually have the largest protection gap, with insured losses accounting for less than 10% of the total economic loss, meaning we have over 90% of protection gap in the APAC. And again, this highlights the challenges that the emerging markets in APAC have been facing in closing the protection gaps. Now, in terms of the human losses or fatalities due to natural disaster last year, there were at least 42,000 people lost their lives globally last year. And from the regional perspective, more than 24,000 of the fatalities occurred in Europe, mainly due to the European heat waves. And the second largest event in terms of fatalities is actually the Myanmar earthquake that occurred in March last year. And in total, in Asia, last year we have about 14,000 fatalities linked to the natural disasters. And actually, based on our long-term record since year 2000, the number of fatalities actually exceeded 1.9 million worldwide. So let's take a deeper look into the losses in APAC. Now, these are just some examples of the notable events that occurred last year. North China flooding, Myanmar earthquake, some of the cyclonic storm and tropical cyclones, typhoons in the region. Not going to discuss them in detail for each of them, but I do want to draw your attention to the breakdown of the economic loss and insured loss by peril for the APAC region. Now we can see that this light blue color denotes the economic losses for flooding, which is the main peril contributing to the economic loss last year for APAC. But if you look at how much of this was being insured, it's only a fraction of them in terms of the insured losses. It's only a small fraction of the 7 billion insured losses in APAC. And if you zoom in closely, to where we are in Southeast Asia. Sorry, based on the long-term statistics that we have since year 2000, only 12% of the total economic losses caused by flooding were insured. Now, this again highlights the significant room for improvement and opportunities to actually close the protection gap in Southeast Asia and APAC in general. So what I've just shared reflects the impacts that we have experienced in the past to date. Now, the pressing question is, how might these losses change in the future under the influence of climate change? Now, this is in fact some of the work and analysis that we have been doing at Aon. We have developed our own proprietary view of the future risks, drawing from multiple sources, for example, the climate projections models, climate conditions catastrophe modeling, as well as our long-term loss data and industry insights. Now, of course, given that this session is just an introduction, we won't be covering this particular topic in depth, but do feel free to connect with us and happy to have a follow-up discussions if it's of interest. So we have seen the losses and the significant impacts caused by the catastrophe and climate risks based on some of the statistics that we have gathered last year. Now, these physical impacts and losses are not the only reasons why it matters. Another driver to the climate actions taken by the countries and businesses is regulations. So next, I'll just spend a couple of minutes to talk about the regulatory landscape that's relating to climate change. Now, the foundation of global climate regulatory landscape is really built upon the international agreements that set broad targets and frameworks for climate actions. The United Nations Framework Convention on Climate Change, UNFCCC, and its subsequent protocols such as the Kyoto Protocols and the Paris Agreement of 2015 are central to all these efforts. For example, the Paris Agreement in particular commits almost every country to limit global warming to well below 2 degrees Celsius above the pre-industrial levels, of course with efforts to cap it at 1.5 degrees Celsius. While these agreements are non-binding, but they do provide impetus for countries to develop their national strategies and also submit the nationally determined contributions, or NDCs, which communicates the country's targets to reduce greenhouse gas emissions. Now, at the national levels, there are also climate-related framework laws that create the overarching governance structures for the country's climate policies. For example, the Climate Change Act 2008 in the UK is one of the first laws that established a long-term, legally binding framework that cut carbon emissions to achieve net zero by 2050. Of course, the other countries have also introduced their own legislations like Denmark, France, Mexico, Sweden, and New Zealand. Aside from the international agreements and the national framework laws, a growing emphasis on the transparency and accountability has also led to the emergence of climate-related disclosure frameworks or standards. As you can see on these charts, there are many of them, and some of these standards have overlapping core properties, leading to some redundancy. And they vary in complexity. Some of them focus on historical or backward-looking data, like the CDP disclosure framework, whereas the other ones, like the Task Force on Climate-Related Financial Disclosure Framework, TCFD frameworks, focus on a forward-looking or future-looking disclosure. There are, of course, various advantages and disadvantages of these reporting standards. So companies sometimes end up having to do use a combination of them. In recent years, the TCFD frameworks have also become one of the widely adopted voluntary standard as well. And in June 2023, the International Sustainability Standard Board, ISSB, has also launched its first IFRS sustainability disclosure standards, known as the S1 and S2. S1 is for the requirements relating to general disclosure of sustainability-related financial information, whereas S2 focuses on climate-related disclosure. So since then, the ISSB or IFRS foundations have taken over the role of TCFD in monitoring some of the progress of the sustainability-related or climate-related disclosures by businesses and companies. Now, this, other than that, we can also see that some other frameworks or standards are also being consolidated or merged or included in one way or another into the IFRS framework. This move was a response to strong market demand for a unifying sustainability reporting standard. Today, IFRS S1 and S2 aligned disclosures have been adopted in many jurisdictions in the world, including Singapore. And this is just an example of the sustainability reporting requirements in Singapore by the SGX. We can see that we have taken a phased approach, requiring the companies of different sizes to start reporting or disclosing climate-related matters in their reports. So this is the end of the first part of the session today. We will have a Q&A session at the end of the session today, so happy to discuss more with you. But now I will hand it over to Muhammad for the next part of the session. Thank you. Muhammad, over to you.
Thank you, Yap Foong. And I echo Yap Foong's thanks in extending our thanks to the Singapore College of Insurance for hosting this session. So you will see that I'm going to elaborate quite a bit on climate change and catastrophe modeling in terms of their differences, opportunities presented by climate change for the industry, and other considerations that we have to factor in. Yap Foong will then resume the talk by giving some case studies. Next slide, please. I would like you to think of the question that is being posed here. Is it the role of the industry to address climate change woes? Just spend a few seconds. My opinion is no, and I'd like to have a debate with you if you think otherwise. It is not the responsibility of our industry to address climate change issues in the sense of providing solutions to reduce greenhouse gases, and in doing so, limit temperature rise, as what Yap Foong has mentioned. However, for the industries that are doing that, for example, primarily the technology companies, they need backers. And this is where our industry comes in. We are the bolts and nuts of societal progress, without which any undertaking becomes risky. And in the context of climate change, we are the greatest supporter of industries that address climate change. The primary aim of our industry is to reduce the protection gap. When there is no insurance, activities are likely to come to a standstill because there is low resilience in the face of any impact. I list several reasons why insurance is important. For example, the inability to access capital. No banks will insure a business if it has no insurance cover because of higher liability. And insurance policy also acts as collateral for the bank loan, and the lender is usually entitled to up to 90% of the policy surrender value. The second example, increased vulnerability and it limits growth and therefore innovation. The absence of insurance would discourage entrepreneurship, investments, and innovation. Businesses would be reluctant to take on new ventures or expand without the protection that insurance provides against potential losses. It is not to say that without insurance, everything stops. The emphasis here is that when you have insurance, the risk is transferred to another party. Without insurance, that risk falls solely on those affected, potentially leading to financial ruin. To simplify climate change further, the increase in temperature is likely to shift the temperature distribution towards the right, as shown in Figure 1. This means that the world will now be in a new climate state, in which what was previously extreme weather is now commonplace. You will hear terms like more frequent extreme weather or more intense extreme weather, or a combination of both in climate change talk. But how you reduce the protection gap in light of climate change is similar as you are currently doing. But climate change comes with a heightened scrutiny. That means there is more to think about. In the next slide, I will share some light on what these considerations are. I try to simplify the processes involved in insurance and reinsurance. I try to simplify the process involved in insurance and reinsurance. And a lot of you would have known this, but it's for the benefit of the wider audience. It all starts with the risk. The insurance company will then decide whether to underwrite that risk. This will be in line with the company's risk management framework. The key question surrounding the risk is this a good risk or is it a bad risk? Should the company decide that this is a good risk, then the next step would be to have a structure that reflects their risk appetite. The company can then consider if facultative or treaty reinsurance is necessary as a form of risk management. If there's no reinsurance, the contract incepts and hence the big weight, hoping that there are no claims. If yes, the flow then moves to the reinsurer, who essentially asks the same question: what is my risk appetite? The contract incepts again. The concept incepts and again the big weight, hoping there are no claims. At each stage of the process, you can introduce climate change. Now, bear in mind that climate change does not happen in an instant. The introduction of climate change here refers to what if you consider climate change in the process. This is where the additional scrutiny is needed. This scrutiny will require you to review the two questions that you've been asking. Is this a good risk or bad risk? What is my risk appetite? As far as risk is concerned, what is the exposure of the risk to future climates? It may be a good risk because it is risk-free now, but 20 years down the road, that risk could be highly susceptible to hazard. How certain are you on the vulnerability of that risk to climate change? Meaning to say, is the modeling robust? There may be retrofitting to the risk structure or the environment that surrounds the risk in the future. For example, the building of flood walls. How do you incorporate the future cost dynamics? If the risk is no longer favorable in the context of climate change, you can reject the risk because it forms the burden in the long run. Rejection is the easy way out. Should you stick to it, should you choose to stick to it, then you need to consider the costs involved. There are solutions to the dilemma, and Aeon has several solutions to address them. As far as risk appetite is concerned, your risk appetite may change based on what you know of climate change. Is there model consensus across the 134 models that points to the evidence and the direction of climate change for the risk that you are interested in? I have a strong belief that a risk is not a risk if you can manage it, and central to that management is understanding. Can you proceed to the next slide? I'm going to give you slightly more comparison between modeling climate change and catastrophe just to increase your level of appreciation. You'll see here that there are some fundamental frameworks, releases, components, approach between climate change modeling and catastrophe modeling. The key difference that I'm going to just highlight would be climate change modeling shows the changes in atmospheric parameters. For example, how temperature or precipitation changes, say, in the 2030s compared to the 2000s. It is not an impact model, meaning to say it does not tell you if the flood magnitude or extent over a selected area will increase or decrease in the future, unless you feed that output of the climate model into an impact model. However, it's often inferred that if you have high temperature, you would then have higher precipitation, and therefore that leads to higher flooding instances. The second key difference is output from climate change models do not tell you how much financial loss you are going to incur in the future. The loss feature is available in the catastrophe model as represented in the financial module. A third key difference, catastrophe models are not bound to any governance, whether it's international, national, or even societal, that provides framework for scope and methodology. The availability is at the discretion of the model provider. That means to say, the model vendor will decide when to release or update the model for a given territory and peril. There is no single source of truth to say which model is right or wrong. In climate modeling, the robustness of the model can be represented in the saying the present is the key to the future. How well it simulates the present-day climate will then inform how robust or reliable the model is in simulating future climates. In catastrophe modeling, there is no future climate. The loss simulated by the model is a key indicator of model validation. For example, how does the model loss compare to the client loss for the 2011 Thai floods? Can we move to the next slide? In this slide, I view opportunities in two angles, two perspectives. This reflects the opportunity to seize more business and the opportunity to be more resilient. I classify them into direct and strategic. In the direct opportunity, there are clear developments in the market that benefit the industry. For example, the rise of EV market entry, where more vehicles means more business, more homes means more policies underwritten. The second one would be strategic, or what I would call it precautionary. We often see things from our own lens and not realizing how things interact. Looking at this angle, we invest in aspects that allow us to tap into bigger opportunity or even avoid opportunity costs before the actual rewards are realized. I borrowed EY's framework of 7 growth drivers and tried to fit examples of these opportunities, both strategic and both direct and strategic. And I have identified 4 key categories, which I'm going to discuss over the next 4 slides. In the next slide, there is a clear and direct opportunity for the industry in terms of the investments made towards climate change mitigation and adaptation. So in a nutshell, mitigation is all about limiting temperature change to 1.5 degrees Celsius by the end of the century. And this is achieved by having net zero emissions by the 2050s. In terms of adaptation, we make adjustments in natural or human system to reduce the harmful effects of climate change. And in terms of adaptation, you have to consider all 3 short-term, medium-term, and long-term options. The crucial point about adaptation is not to exacerbate future situations or jeopardize current situation. And you know that there are opportunities when money is being pumped into the system. Globally, the climate finance has picked up pace. There is a twofold increase in financing from 2020 to 2023 compared to 2018 and 2019, which hovers around 800 to 900 billion. For APAC, 12.2 billion is being invested. That's the GDP of Brunei. The priority is to limit temperature change to 1.5 degrees Celsius, as I've mentioned. But it is not surprising that mitigation finance also forms the bulk of the investment. So over here, we've got 60%, 60% and 39% for mitigation and adaptation, respectively. In terms of the sectors that benefit from this financing, energy and agriculture are key beneficiaries. Now, think about the direct opportunities that come with this financing. Don't just look at the product, say EV, but look at the entire ecosystem that comes with it. At the very basic, you need the facility that forms the input, you need the process and the market that forms the output. At each point, do you have a product that caters to it? How can you innovate further? Take, for example, floating solar panels. As I understood it, you don't just insure this floating panel, you need to understand and identify key risks areas. And there are several. Firstly, mooring and anchor failure. This is brought about by the damage due to water fluctuations and wind impact. What about operational hazards? Such sites are also such facility are often at isolated sites where firefighting is difficult. Corrosion hazards such as the intrusion of salt water or high moisture, third-party liability, for example, protection against pollution. Now, I've been in this industry for 9 years, and I have heard non-common, at least to me, insurance products such as MAID insurance and solar PV all-risk insurance. I've also heard of other non-common insurance, which are rather wacky: body part insurance, mustache insurance, taste buds insurance, and even alien abductions insurance. These are valid insurance products. You can look it up. The point I'm making here is that there's no stopping you from introducing new products. When there is a risk, there can be an insurance product. And if there's none, why not pioneer it? Can we move on to the next slide? Now, climate change hits different regions differently. There are winners and losers. We often hear more about the losers, how Bangkok and Venice will sink in distant future, how future climates will affect food and water security, and so on. But little is known about the winners. Winners in climate change are specific. These are countries or regions at the high latitudes which benefit from warmer climate, or predominantly hot countries which benefit from increased rainfall. Google it and you find a good amount of resource pointing to Canada, North America's Great Lakes, and Nordic countries. These regions are expected to benefit from, at least from a theoretical standpoint, an increase in arable land where agriculture growing season will expand significantly. Now, Canada is projected to be the breadbasket of the world in the future. And the opening of shipping routes, particularly the Arctic Sea route, which will reduce travel time. Now, think about your marine cargo insurance. Now, for Middle East and North Africa, the northward shift in the ICTZ, that is the rain belt, means there will be more rainfall, and therefore there's a potential of increase in agriculture. Property is the bread and butter of the industry. Hence, you would have to rethink your strategy towards real estate. This is where the second opportunity scope, which I call strategic, comes in. Borrowing from Munich Re, you have to think about how the exposure of your asset matters in the context of climate and climate change. In a similar way, look at how other aspects like building vulnerability adaptation plans is impacted by climate change, and how these are what are the strategies taken to respond to climate change, and examine why they matter. In short, it matters because the quality of real estate in a city will determine the susceptibility and resilience in the light of future climate. Cities which are more climate friendly attract long-term investments. Now, the question that you should be asking is that, is our industry doing enough to promote climate resilient real estate and cities? Can I have the next slide, please? This slide presents several takeaways. Don't look just at the physical risk only. Look at the interconnectedness of the risk in the supply chain. The impact of natural catastrophes has a trickling effect on demand and supply. In catastrophe modeling, this option is called demand surge, meaning to say it is the increase in the cost of repair or replacement of damaged property. You know what happens when demand exceeds supply, the costs increase, and this is what's happening in catastrophe modeling. In the same fashion, water and heat stress in inclement weather at one facility may likely increase the facility's operating costs. And then this has downstream impact where the increase in operating costs is then passed down to consumers. If you remember decades ago, the bird flu pandemic, it disrupted the supply of eggs in Southeast Asia. And back then, if you are living luxury if you have eggs in your household. Disease congenial weather, that is weather favorable to development of pests and diseases, has been said to be linked to the rise in temperature. And this aspect of weather is a component in parametric crop insurance in India. In the context of future warmer climates, it is likely that there will be more disruption in the supply chain and therefore influencing downstream costs and activities. This is where business interruption insurance can thrive. Now, new products and solutions are constantly being developed for better decision making. Catastrophe property cat modeling has always been the forefront of risk assessment in insurance, whereas casualty is lagging, so much so that the impact of casualty from the same event has less of a shock element, and therefore it gives the impression of lower importance. Now, days ago, a leading model vendor released the industry's first casualty probabilistic catastrophe model. Prior to this, modeling casualty takes the form of curve fitting, experience rating, and exposure ratings approach. The availability of such models, the casualty cat models, allows one to assess the impact of casualty robustly. And the casualty catastrophe model has a stochastic component that allows you to access the loss at a given return period, just like property cat models. This stochastic component can be conditioned to reflect climate change. Now, climate change catastrophe models are available in the market, which you can use to account for climate change in your pricing. I think the utmost opportunity that climate change gave is it allows us to review how we transact. At present, traditional insurance still forms the dominant transaction, where contracts are renewed annually, providing flexibility for rate adjustments based on claims and market movement. Can we or should we explore other means which can supplement or act as alternative to traditional insurance? Several of these have already a climate view, hence it is not difficult to incorporate a climate change view. Next slide, please. Now, it is essential that we have the right people to provide perspectives on climate change. In the report by the Boston Consulting Group, only 29% of corporate boards have knowledge on climate change. And in a way, it reflects the company's strategy. You cannot pursue something robustly without knowledge, and that in turn cannot create value for your customers and partners, and also for your employees. This has wider implications on corporate governance and liability. Figure 7 shows the rise in the number of climate-related lawsuits against companies. You can be sued, and scientists are helping plaintiffs with evidence, especially with attribution and detection studies. If you're not versed in climate change matters, how are you going to defend your company? And what aspects are you going to defend in the first place? Climate literacy is not just for the C-suites. It is needed for the people who are actually running the business. And I'm referring to analysts like actuaries, catastrophes, the CATMARK managers who do the loss modeling. These are people who advise on price and profitability, risk appetite, and capacity. A well-informed actuary, for example, can factor in modeling uncertainties and apply appropriate loadings for pricing to account for climate change. Can you move on to the next slide, Yafung? I'm going to look at the other considerations. Now, climate change is not the only factor that governs loss. On a year-to-year basis, you know that the losses are exposure-driven rather than climate. Political decisions such as war and tariffs have impacts on replacement of raw materials, the demand surge as what we call it in CAT modeling. We also need to be realistic about what we expect of climate change. Yap-Fung spoke about weather and climate prediction. Weather and climate are totally two different experiments. It is not realistic to say that I cannot incorporate climate information in pricing and structuring for the next renewal, as I do not know if there is a flood if there will be a flood in August this year. At some point, we cannot mitigate any further, and we have to adapt. But we need to remember that there are limits to adaptation. How much lower can air conditioning cool your room before stress kicks in? And my personal interest is to identify that limit and to address the issues that center on that limit accordingly. Next slide, please. So I'll just wrap up the scope of work that we've done so far in part 1 and part 2. In part 1, Yap-Fung spoke about the rise in catastrophe and their impact in terms of economic losses. There is a huge protection gap of 51% globally with a gap of 90% for Asia. Looking at the trends in the frequency and magnitude, past and recent catastrophes are an indication of the effects of climate change. And these events serve valuable lessons. Firstly, they provide a checkpoint where models can be validated and subsequently improved. Secondly, resilience and recovery would be critical. You could be looking at it in the form of an event that has happened that has impacted your asset, a near miss, which is the event that is close but did not impact your asset, and what could have happened. These are the scenarios. In any of these situations, the question you should be asking are, how effective or how adequate is my insurance or reinsurance? And what is the aftermath response? Am I more resilient? Yap-Fung then talked about climate change and how various factors operate to make it intentionally or unintentionally complex. Now, identifying risks has always been the key in insurance. In the context of climate change, the quantification is only the start, a triage. In part 2, I have shared some insights on the opportunities from climate change. This primarily come from the increase in market entry of emerging businesses such as EV as part of mitigation and adaptation strategies. If risks can be identified, a product is viable. Other opportunities require us to review how we conduct business, from operations to having the right people. Things are interconnected. For example, what we do in the financial lines affect other insurance lines. We don't see the webbed linkages, and no one has attempted to show it. Yes, climate change is a distant concept for annual renewal. You don't have to wait for climate change. The rise in catastrophe in terms of magnitude and frequency is already evident. There are tools that allow you to account for climate change, and even with that, if that is still in action, it will come to you in the form of ESG reporting and regulatory standards. Before I hand over to Yap Foong, I would like to make several emphases. Firstly, incorporate climate change as early as possible. It will be challenging, but tools and frameworks exist. Addressing climate change is a bespoke practice. It is dependent on your resources and your agenda. What works for one company may not work for the other company. You cannot address climate change without analytics. Specialized tools are developed to address niche aspects of climate change, and Yap Foong will then proceed with several case studies from Aeon. Over to you, Yap Foong.
Thank you, Muhammad. Thank you. Just before I show you the examples of the case studies, I would just like to show you, give you an overview of the approach that we typically take to help our clients to address climate risk. Typically, we'll take an iterative approach, helping them to firstly identify the risk by doing a climate risk assessment, take into account all the three components of climate risk, which are the hazard, the exposure, as well as the vulnerability. So we do take into account the asset geolocation, the asset value, to assess the exposure, and then we look at the climatology and the hazard projections between now and future to know what we can expect from the impacts of different perils. And other than that, we do look at how susceptible the asset types are when exposed to this peril. And after we have identified the risk, the next step is to really evaluate the impact in terms of financial impacts and monetary consequences to our clients. For example, we do estimates, repair replace costs, cleanup costs after an event, or the impact to revenue due to business interruptions. And with these risks identified and impact evaluated, we then develop risk reduction and adaptation measures for the risks that we can reduce, but that we can adapt or mitigate. But for the risks that we have to retain or the clients have to retain, we also work with our colleagues in the broking department to design the appropriate risk transfer solutions or insurance programs for them. So after that, this process will also be repeated, and then we will then identify the residual risks after the consideration of the risk reduction measures. And all these can be done with the help of the analytics capabilities and tools that we have. And some of these are developed by the team in Singapore as well. For example, the Climate Risk Monitor. This is the climate projections modeling tool that we have to help our clients to assess the current and future risks for their global portfolio. We also have other tools like Combined Hazard Information Platform, CHIP, which has been in use for more than a decade in the Australian and New Zealand markets. And as Mohammed mentioned, we also have access to catastrophe models, whether it's from the vendors or our in-house, we have an in-house team developing the catastrophe model called impact forecasting as well. Last but not least, there are also a suite of different analyzers that we can use to help our clients in understanding their risks. Now, in terms of the project types of deliverables, we do help with detailed risk modeling. We also work with our engineering team on asset resilience enhancement, and we help our clients in the technical due diligence exercise as well to help them decide on which sites or assets that they should acquire or invest or divest. Of course, risk transfer, design of the insurance program, access to insurance markets, creating the capital capacity are also the core business for Aeon. And last but not least, we do help with the climate disclosure and reporting as well. So this is just one of the examples or one of the recent projects where we help a real estate developer with a global portfolio of more than 200 assets globally, that's headquartered in Singapore, to conduct a physical climate risk assessment for them for each and every of the assets, and for both acute and chronic hazards, including drought, extreme heat, freeze, wildfire potential, tropical cyclone, different types of flood, including flash flood, riverine floods, and coastal floods. And we have done that for the different SSP scenarios and across 3 time horizons for the present day and 2 time horizons in the future as well. So we use our proprietary climate risk monitor, where we can then help to understand what the risks are for the clients, contributed by each of these perils that we assess. And aside from qualitative risk classifications, we do also help our clients to understand what is the expected losses in terms of quantitative numbers and outputs from tropical cyclones and the 3 different types of floods that we have assessed. So what the client receive is that they have an understanding of the average annual loss and also the probabilistic losses at different return periods at each of their assets for the 200 portfolio of the assets. And we also show them what's the expected change in terms of the losses today and how is it expected to change in the future as well under the different climate scenarios. And with that, we have enabled the client to firstly identify the most at-risk assets across their global portfolios, and also help them to understand how these risks across these different assets are projected to change over the coming decades. Now, this would then help them to direct their resources and spending more efficiently so that they could allocate the appropriate resource to the riskiest assets in the portfolio so that they can then proceed with the resilience enhancement measures to reduce the risk. Now, this is another example. We have also done a series of projects and deliveries for our clients in the banking and insurance industries as well, using the other tool that we have called the Combined Hazards Information Platform. And within these two, we have a very detailed exposure data, meaning we have the attributes data at street level and building levels in Australia and New Zealand. And then this is also combined with the hazard data layer, where we have data for flood, different types of flood again, bushfire, cyclone, windstorm, and hailstorm. And we have that not just for the present day risk, level of risk, but also we have the risk data, hazard data for 3 different climate scenarios for the future time horizon as well, for present day, the 2030s, 2050s, and 2090s. So some of the outputs from the platform is that we would be able to provide an estimate of the average annual loss due to these different types of perils that we assess. And as you know, the ALs is also one of the metrics used in the technical pricing of the premium. And it's also the break-even cost, actually, if we are doing the technical pricing. So with this information, the insurers and the banks can also use them to assess their very credit risk, liquidity risk, operational risk, and they have also used it to fulfill the capital stress testing requirements, which is required by the central banks and financial regulators in some of these countries. So to wrap up, this information or data that we provide, insights that we provided alongside the advisory services that we provide to our clients in the banking and insurance sector, we have helped them to integrate climate risks into their overall risk management processes. And also again, this is also used to help and meet the regulatory requirements. It's not just for the sustainability reporting disclosure requirements, but also the climate stress testing requirements imposed by the central banks. And at the end of the project, we also explore the risk transfer options with the banks and insurers to help build the resiliency of their books. So I think this is the end of the deck that we'll share today. So I think it's probably a good time now for the Q&A session.
Hi, thank you, Yapfong. Hi, this is Shalini. Thank you, Dr. Mohamad. I'm just going to quickly run through some of the questions that have come in. I think maybe we'll go to the first question since it's related to what you just spoke about, right? In terms of the services that Aon provides. Now, as a leading global insurance broker, what climate change related services do you offer to your clients today in Singapore or globally, and which customer segments have shown the strongest demand for these services?
Right, that's a good question. I'll take it, but Muhammad, feel free to jump in anytime to add on. So I think in terms of the first part of the question is what climate-related services that we offer to clients today. I think there's a wide range of the service offerings that we provide. For example, detailed risk modeling, whether based on climate change modeling or catastrophe modeling. Those are the things that we provide. And of course, other than that is the asset resiliency enhancement. As you may not aware, Aon, we do also have a department or a group of engineers where they would also help to, we can work together with them to enhance the resiliencies in terms of the adaptations measures needed. And of course, reporting and disclosure and technical due diligence exercise, also some of the things that we did. For example, recently we have just completed a technical due diligence exercise for an M&A merger and acquisition project for renewable power plants, where we combine both climate modeling using climate risk model as well as catastrophe modeling to give a robust view of what's the expected losses current for the present day, as well as how these impacts may evolve into the future. The second part, in terms of the customer segments, we are industry and sector agnostic. But typically, in terms of the deliverables or the projects that we have conducted, it's again quite a wide range of the sectors that we have served. For example, the financial sectors, the real estate sectors, FAB sector, agriculture, logistic companies, and also transportations as well. So I think we have seen equal demands from each of the segments, but it's just that the type of ask that we are getting from the different customer segments or sectors are different. Yeah.
Okay, I mean, to be expected. Okay, moving on. I think we've got a bit more questions here. I'm not sure who's going to take this, but I leave it to you all to decide. We know there are many types of analysis that can be performed. However, from a reinsurer's perspective, if the available data is not sufficiently granular, how much meaningful analysis can actually be done, and what are the practical limitations, and how do you address them? Who will be taking that?
I can take that.
Okay, go ahead.
The short answer to that is that data will always be an issue, and it has been an issue in the markets that we serve. Some markets have got granular data, which is good to work with. Others do not have that kind of information. But that doesn't mean that we cannot work with whatever information that exists. You just have to treat the output with caution.
Okay.
And there are several ways that we can address this. We can look at an exposure database from Aon's market portfolio, where we have granular data, and we can show you what is the impact if you give us more granular data compared to whatever you have now.
Okay. All right. Next question. How do you determine which toolkit to use for specific industry or business? And will the use of the different toolkit affect the end result? Will the findings also be shared to the underwriter for their consideration?
Well, I can take the first part of the question, of course.
Right.
I mean, in terms of the toolkits, there are a plethora of toolkits available in the market when it comes to climate change modeling. I think my tips to everyone is that look beyond the interface, the UI and UX of the toolkit, to really examine the data used behind these toolkits. Because a lot of the toolkits are relying on the climate models that I discussed or mentioned earlier. But one thing that I have not covered in the previous sessions, I mean, again, it's an introductory session, is that there are a lot of biases or systematic errors with these climate models. So one way that we at Aon, we have taken an initiative to address these by doing a very robust bias corrections and calibrations work to the outputs of these raw climate projection models, using separate data sets that's more representative of the actual climate conditions that we experience today. So the short answer is do question and challenge the data used behind these toolkits. Yeah.
Can you give us an example of that bias that you mentioned? Maybe one
Right.
example?
Sure. So for example, the latest global climate models that are being used today, they are based on the baseline that's used in these climate models is up to year 2014. And if you think of that, 2014 is about a decade old from today. So what we have done is that we incorporated the most recent what we call reanalysis data, or data that's derived from the actual observations from the weather stations, for example, to help calibrate our future projections in our modeling tool. So that would then give us, firstly, a more updated baseline to be more representative of what we have experienced today. And that's important because if we can't get what's the conditions today right, it's even harder to get what's the future projection right. So yeah, I mean, I can share more about this in another session. We have recently filed a patent for the work that we have done as well. So
I see. And in terms of whether the findings can be shared, sorry, Dr. Mohamad, do you have something to add to that?
Yeah, I can just touch up on just one point on the first question. Yes, there'll always be various perspectives offered by the various service providers, and like Yap Foong said, do question and challenge the data. And this is where I emphasize that if you are climate literate, you are in a good position to question the service providers. And will the findings be shared with the underwriter? If you are our client, it's up to you to decide to whom and what you want to share it with.
And Dr. Mohamad, I think that brings to that next question when you talked about climate literacy, right? So I think in one of the slides you talked about 29% of corporate boards have sufficient or relevant climate knowledge. Now, what steps can insurers take to build that climate literacy, right? Whether at board, at senior management level, to sort of like improve governance and decision making. I mean, what do you think, or what are you seeing across, say, in your across your clients, people that you're advising? What are those best practices that you're seeing?
Yeah, so the first step is to attend sessions like this. And I think we have about 400.
I hope we have boards here and senior managements here in this call, but okay.
Yeah, so the first step would be to build up your knowledge on in terms of climate and climate change, build up the literacy by attending such courses. If you have a service provider, engage them. It is likely that they have a dedicated unit. For example, Aon has the dedicated climate risk advisory that can offer you such training or even help you with any of questions that we have related to climate change. And thirdly, make climate change an agenda in the company. That is a key strategy. If you do not have that strategy, then there will be a lack of awareness, and with a lack of awareness, there is no incentive to take up climate change as a strategy in your company.
Okay. I mean, and I think that's a good segue because a little bit to say about SCI as well. I think just like Aon has a comprehensive suite of programs on climate change, I mean, so does SCI. In fact, as we were trying to figure out how to build that foundational knowledge on climate literacy, that's why we offered complimentary to the industry here in Singapore, foundational knowledge on climate change. That's available. Speak to us, drop us a note in the chat, or Darian, you can put in our calendar, maybe some information on the complimentary program for our Singaporean industry as well in terms of the climate change program. Because again, building that foundational climate literacy is so relevant, I think, as Dr. Mohamad mentioned. Next question on, is the climate change model specific by country, similar to CAT modeling? Does it consider the varying climate change impacts to each country?
That's a good question. So the source of the climate models data that we use is based on the global climate projections models, which means the models have global coverage. But
Okay.
of course, different countries, they will undertake a downscaling exercise, meaning they will based on the data from the raw global climate projections model, they will also produce another set of country-specific models for that particular country at high resolution and whatnot. So yeah, the question is yes and no, depending on the source of the models or the types of models that you use.
Okay, very good. Next, I think Dr. Mohamad, I think you covered this on the difference between climate change modeling and catastrophe modeling. Now, from an underwriting and capital management perspective, how should insurers integrate long-term climate projections into short-term pricing and portfolio decisions?
Yeah, this is quite interesting, also quite difficult to answer because you see climate change as an industry, in an industry perspective, is rather new, and therefore whatever solutions that exist is still in its infancy. So we are still trying to develop solutions on what can be done. So again, this is something that we need to work together to see what is the optimal outcome to incorporate long-term climate projections into short-term pricing. But I would say that the first step would be to consider this kind of projections first into pricing. For example, what is in light of future climate change, what is the maximum pricing that is that I would expect compared to having a pricing done without climate change. So start off with that one first. And what kind of issues are you facing? If you are facing with capacity, capital issues, then it would be fruitful to address those issues and see how it comes about.
So it's a bit of like I guess it's an iterative process, right? You're just trying it out and see how that works. Okay. Next one. Given that APAC has the largest protection gap, with insured losses accounting for less than 10% of total economic losses, what practical strategies can insurers adopt to expand coverage while maintaining risk discipline and profitability? I think this was in the slides that you covered, Dr. Mohamad.
Yeah, I can answer this. This is quite difficult because the protection gap comes. The reason why we have protection gap is because of issues that surrounds insurance, and we need to identify what those issues are. For example, if you look at places like the Philippines, the community is financially literate. However, they choose to park their resources into something more tangible, short-term tangible. For example, they like to invest in education, invest in other aspects as compared to insurance. Now, how the challenge would be, how do we actually make it more attractive for the policyholders? Now, this again, something that needs to be explored within the members of the community.
Okay. All right. 4 more questions to go. Do we see an increase in insurance premiums in Southeast Asia due to climate change over the past few years? A little bit of a crystal ball, I think, maybe. I don't know.
Yeah, correct me if I'm wrong, Muhammad, but I don't think that's the case, even though I wish that's the case, because if that's the case, that means that climate change impacts have been taken account into the premium and the pricing. But in this part of the world, in terms of pricing, a lot are still based on experience rather than technical. But yeah, Muhammad, feel free to add.
Yeah, I agree. In respect to climate itself, it hasn't been factored in, and let alone climate change. So it doesn't. I believe it doesn't reflect that statement.
I think it's probably related to whether or not the last question on in the current soft market cycle, do reinsurers and brokers price in the increased climate risk in their pricing and analysis? Would your answer be the same then? You are pricing
Sorry, I
in
can't hear.
in the current soft market cycle, do reinsurers and brokers price in the increased climate risk in their pricing and analysis? So would that be the same, that you don't think it is affecting the price?
Now, I've
But
worked
it
with
is
actuaries and
priced in?
brokers, and yeah, I don't think it has been factored in into their pricing structure. No,
Oh,
they have uncertainty loadings, but I doubt the uncertainty loadings include climate change factors.
I see. Okay. Okay, to what extent are climate conscious companies able to access longer term property insurance products?
You want to take that?
Yeah, I can't. This is beyond the scope of what I do. So
We
I
can
have
come
to
back.
get back to the question.
We'll come back to you on this question.
Yeah.
Okay, we've got a little bit of a complex question here. I think the slides, are you okay to share these slides after the presentation? I think there's a question on whether we're sharing.
Yeah,
Yes,
sure.
we will send that out after this session, maybe in a day or two. So you can expect that. And what is the alternative for CHIP in the Asia region?
So we do have the CRM climate risk monitor, which covers the globe. So we do have that. Of course, there are other data layers as well that we are developing for different hazards. So yeah, I mean, happy to have a chat if you're keen to find out more about that.
Okay, very good. I think we've covered all the different questions. Anything else to add, maybe to close us out? Yap Foong, Dr. Mohammad, anything to say in addition to everything that you've said?
No, I just want to thank you again. Thank the Singapore College of Insurance again for coordinating this event. I think this is a very useful event for all of us. I think this is a topic that everyone is talking about, so it's good to have some kind of knowledge sharing and exchanges among all of us. So I think really beneficial to the industry.
Okay, and I think there was something, Dr. Mohammad, anything to add?
No, I agree with Yap Foong, and I would advise that if you have any question related to climate change, approach your service providers. Aeon can definitely help. Feel free to reach myself or Yap Foong, and I would prefer if you challenge us, because once you challenge us, we are, it knows that we are putting our heads and hands together to think about the solutions.
Okay, very good. And I think in the slides, as well as what you see on the screen, both Yap Foong and Dr. Mohammad's contact information are there. So do reach out to ask them any questions or challenge them, which they look forward to in the coming days. I think we have one poll that we wanted to run. I think there was a question on in terms of I think ISSB and all that. Not related, Yap Foong, Dr. Mohammad. No, don't be surprised. We wanted to run this poll. Okay, so don't be surprised, because I think we were trying to see whether there's interest in terms of GRI and ISSB for sustainability reporting, whether or not there's interest training, which we also conduct, and we were trying to see whether or not people will be interested in this training. So, do answer the poll. It's up on your screen right now, and that gives us a sense, of where the demand lies. So we're interested to know what you are thinking about that. Okay, again, I want to say thank you so much to Mr. Yap Foong, Dr. Mohammad, Aeon. Thank you to, of course, our team, Darian, who's running this quietly at the back. Thank you so much, everybody. Have a good day. Look forward to seeing you at our next webinar, and maybe hear more from Yap Foong and Dr. Mohammad on this important topic. Thank you so much. Again, thank you, everybody. Have a good day.
Thank you. Thank you.
Thank you.